Well, I agree with you that we're technically in a recession. I disagree with the idea that it's anything close to 2008. It's like night and day. We're just coming off a period of seasonal weakness. In the United States, September tends to be the worst month of the year for the stock market. And we're in a similar situation that we were in June. Going into earnings season, sentiment was very pessimistic. Earnings expectations were very, very low. And analysts were calling for a 20% reduction in earnings revisions. And none of that happened. As a matter of fact, that sparked the summer rally. People weren't positioned for it. And I think we're going into a similar situation here. We have the S&P 500. It's now down 22.5% for the year. But you're seeing earnings expectations only brought down by 3.5%. And I think you have the exact same setup going into earnings, which start tomorrow with the big banks. Analysts are calling for earnings to come down 20%. And I think that the bar for earnings is set very, very low. People are only expecting 2.5% earnings growth for Q3. And I think what they're going to find is earnings growth is a lot higher, and they're not positioned for it. Now, as it relates to 2008, I will say managers are just as pessimistic as they were in 2008 in terms of their positioning. When you look at the Bank of America surveys, of fund manager surveys, expectations for a recession are the highest since they've been since April of 2020, and before that, March of 2009. Both cases, when pessimism levels got this high, the bottom in the stock market was already in the rearview mirror. In the case of 2020, the stock market lows were in March. And in the case of 2009, the stock market lows were also in March. So I do think that there is a lot of positioning for a bad situation, but I just don't think the economics supports it. I think the consumer balance sheet is healthy. I think corporate balance sheets are healthy. And I do think that the biggest risk we face right now is the Fed overdoing their policy.
Amidst of high inflation followed by the Fed's rate hikes, how big is the probability of U.S. economy hit by recession and stagflation started at the end of this year?
Yeah, so I do think you've seen GDP estimates come down to 0.2% if you look at the Fed dot plot. So it's interesting, last year when GDP estimates were 3.8% for this year, the Federal Reserve thought that it would make sense to have a Fed funds rate at 10 basis points. And now that GDP is collapsing and going to be basically flat for the year, they think that it makes sense to have the Fed funds rate at 4.6%. So it's like a dog chasing its tail. Like Winston Churchill once said, generals are always prepared to fight the last war. And my biggest fear is that they're going to overdo it and have to walk it back. We've already seen instances of that in Europe with the ECB having to go into the market and buy bonds for the periphery, like Italy. We've seen it with the Bank of England having to walk back and buy bonds, buy gilts. And we've seen it from the RBA in Australia hiking less than expected. And I do think the Fed will be next. And there are a few reasons that they're going to have to walk this back and maybe not move as aggressively as they intend. First and foremost, inflation is already rolling over. Even the PPI numbers you're seeing, they peaked in March of this year. This morning, we're going to see the CPI numbers. I think we're going to see a similar story. The other thing that we have to keep in mind is Chair Powell has this fantasy that he wants to be Paul Volcker and crush the back of inflation. For every 1% that he increases the Fed's funds rate, it adds $285 billion to the U.S. deficit. So far, we've added $1 trillion a year of interest expense with these Fed fund rate hikes. And while Volcker had the luxury to do that when debt to GDP in 1980 was 30%, Chair Powell does not have that same luxury because our debt to GDP levels are 122%. So right now, that interest expense is approaching the line item of Social Security. So it's becoming very onerous. And I do think that they're going to have to maybe one or two more hikes and then pause. And the market is going to start to sniff that out well before they pause. And we're going to see, I think, a recovery in stocks well before they actually make that pause, many months before, if history is any guide. If they don't do it on a proactive basis, I do think, like in England, like in Europe, the credit markets will force the Fed's hands to ease back when municipalities, when governments, when businesses can't refinance. The credit markets will force the policymakers' hands to ease up on the tightening policy moving forward.
Hayes, as you mentioned earlier about the benchmark of S&P 500, while JP Morgan Chase says that the outlook for the benchmark S&P 500 could fall 20% from the current level and could be much more painful than the first. So how do you perceive this outlook?
Yeah, I think that just embodies the level of sentiment in the market. I'm always skeptical of people that come on TV and after the market's already crashed 25%, say the market's going to crash another 20%. These are usually the same people that before the market went down were very bullish. So you have to be very, very, very careful. I think investors have a tendency to get carried away with the pessimistic sentiment, and you are seeing it in managers. I referred to the Bank of America Global Fund Manager Survey. Managers have 6.1% cash. That is higher levels than the great financial crisis lows and the pandemic lows. So the one thing that no one is possibly positioned for is any good news. If we get a geopolitical favorable headwind, that could be a positive. If we get earnings better than expected, that could be positive. If we get the Fed and central banks to ease up, that could be a positive. If the official CPI numbers, which are lagged data from 30 to 60 days back, start to show a deterioration of inflation, that could be good news that no one's positioned for. And what happens when positioning is this extreme, the pain trade is usually in the other direction. So right now, everyone's positioned for more downside. You just look at the data, that's how they're set up. If you get any positive news, no one's positioned for it. So the minute you get that shock type of initial rally, you get a massive amount of short covering. The first buyers have to be the shorts because they lose money the quickest. And then from there, institutions start to put serious money to work off of the sidelines because they run career risk of being underweight into the end of the year during a period of seasonal weakness. So we're pretty optimistic going into the end of the year.